The price-to-sales (PS) ratio measures the market value of a company relative to its sales revenue and is calculated by dividing the stock price by sales per share. Analysts often use the PS ratio when earnings are volatile, temporarily depressed, or negative, making PE ratios less meaningful. Because revenue is generally less susceptible to accounting manipulation than earnings, the PS multiple can provide a more stable basis for comparison across firms. The ratio is particularly useful for evaluating early-stage, high-growth, or cyclical companies where profitability may fluctuate significantly. However, sales alone do not capture differences in cost structures, margins, or operational efficiency. The justified PS ratio is influenced by several fundamental drivers, including profit margins, dividend payout policies, growth expectations, and required returns. Companies with higher net profit margins can convert a greater portion of sales into earnings and cash flows, resulting in higher justified PS multiples. Similarly, stronger growth prospects and lower required returns support higher valuations. Analysts frequently compare a company's PS ratio with industry peers to identify potential mispricing opportunities. Nevertheless, the ratio should not be interpreted in isolation because firms with similar sales levels may have substantially different profitability, leverage, and competitive positions, leading to different intrinsic values. The price-to-cash flow P/CF ratio compares a company's stock price to its cash flow per share and serves as an alternative to earnings-based valuation measures. Cash flow is often viewed as a more reliable indicator of economic performance because it is less affected by accounting estimates, accruals, and non-cash charges. Analysts may calculate P/CF using operating cash flow, free cash flow, or adjusted cash flow measures depending on the purpose of the analysis. Companies with strong cash generation capabilities often justify higher valuation multiples because cash flow supports dividends, debt repayment, reinvestment opportunities, and long-term shareholder value creation. EV and other aspects. Enterprise value, EV, multiples extend valuation analysis beyond equity by incorporating the value of both debt and equity financing. Enterprise value represents the total market value of a company's operating assets available to all capital providers. Among the most widely used metrics is the EV/EBITDA multiple, which compares enterprise value to earnings before interest, taxes, depreciation, and amortization. Because EBITDA approximates operating performance before financing and accounting decisions, EV/EBITDA facilitates comparisons across companies with different capital structures, tax environments, and depreciation policies. This characteristic makes EV-based valuation particularly useful for mergers, acquisitions, and cross-industry comparisons. The justified EV multiple depends on expected operating profitability, growth opportunities, reinvestment requirements, and the company's weighted average cost of capital. Businesses that generate strong operating margins, sustainable growth, and attractive returns on invested capital generally command higher EV multiples. Analysts frequently use EV-based measures to assess acquisition candidates because enterprise value reflects the total amount an acquirer would effectively pay to obtain the company's operations. Compared with equity-based multiples, EV multiples provide a more comprehensive view of valuation by recognizing the claims of both debt holders and shareholders on the firm's operating assets. Beyond traditional valuation multiples, analysts often evaluate additional measures such as PEG ratios, dividend yields, momentum indicators, and normalized earnings metrics. The PEG ratio adjusts the PE multiple for expected earnings growth and helps compare firms with different growth prospects. Dividend yield can indicate whether a stock exhibits value or growth characteristics, while normalized earnings remove temporary or non-recurring items to improve comparability. Analysts must also consider accounting differences, industry characteristics, and business life cycle stages when applying valuation multiples. Combining multiple valuation techniques enhances analytical robustness and provides a more comprehensive assessment of intrinsic value and investment attractiveness. Residual income defined. Residual income, RI, also known as economic profit, is a valuation concept that measures the income generated by a company after deducting the full opportunity cost of equity capital. Traditional accounting earnings recognize interest expense as the cost of debt financing but do not explicitly account for the cost of equity capital. As a result, a company may report positive net income while still failing to create value for shareholders. Residual income addresses this limitation by subtracting an equity charge from net income. This approach provides a clearer assessment of economic performance by determining whether management generates returns that exceed investors' required rates of return. The fundamental rationale behind residual income valuation is that shareholder value is created only when a company earns a return on equity greater than its cost of equity. If return on equity, ROE, exceeds the required return, positive residual income is generated and shareholder wealth increases. Conversely, if ROE falls below the required return, residual income becomes negative, indicating value destruction. This framework focuses on economic profitability rather than accounting profitability. By explicitly incorporating the cost of equity capital, residual income models provide analysts with a more comprehensive perspective on corporate performance and long-term value creation than traditional accounting measures alone. Residual income concepts are closely related to economic value added, EVA, and market value added, MVA, which are alternative measures of economic profit. EVA evaluates the value created during a specific period after accounting for the cost of capital invested in the business. MVA measures the difference between the market value of a company and the capital contributed by investors. Although these measures are frequently used for managerial performance evaluation and executive compensation, they also have important applications in equity valuation. Together, RI, EVA, and MVA emphasize that true value creation occurs only when returns exceed investors' required compensation for risk. Residual income computation. Residual income valuation estimates intrinsic value by combining current book value with the present value of expected future residual income. Unlike dividend discount models and free cash flow models, which focus exclusively on future cash distributions, the residual income approach recognizes that a substantial portion of value is already reflected in the company's current book value. Future value creation is then captured through projected residual income streams. This structure often makes residual income models less dependent on terminal value assumptions because book value represents a significant component of total intrinsic value. Consequently, the approach can provide more stable valuation estimates in situations where long-term cash flow forecasting is difficult. Computing residual income requires forecasts of future earnings, beginning book value, and the required return on equity. Residual income for a period is calculated as forecasted net income minus an equity charge equal to the required return multiplied by beginning book value. Positive residual income indicates that management is generating returns above investor expectations, while negative residual income signals underperformance relative to the cost of equity capital. Analysts project residual income over a forecast horizon and discount these amounts to present value. The sum of discounted residual income and current book value produces an estimate of the stock's intrinsic value. Residual income models possess several advantages that make them particularly useful in equity analysis. They can be applied to firms that do not pay dividends, companies with negative free cash flow, or businesses experiencing volatile cash flow patterns. Because current book value contributes directly to valuation, the model is generally less sensitive to terminal value assumptions than dividend discount or free cash flow approaches. However, the accuracy of residual income valuation depends heavily on the quality of accounting data and financial statement adjustments. Analysts must carefully evaluate accounting policies, book value estimates, earnings quality, and compliance with the clean surplus relationship to ensure reliable valuation results.